If you are joining us for the first time, hello and welcome. If you're a returning supporter and friend, welcome back. This is Unboxing Economics. Today we'll be taking a look back at the history of insurance. We'll be looking at it from a historical, developmental, and modern perspective. This will finish with what we understand today to be an insurance item, but as that term is relatively new, our analysis will start with matters of risk reduction, financial in nature. The first recorded arrangement of this type, we must go back to Babylonian times, 1800 BC, where an insurance or risk mitigation financial instrument of sorts was bundled with a business loan to facilitate maritime trade. Most of the development and activity in insurance contracts mentioned in today's video will be in conjunction with trade of goods across the sea. These early arrangements, referred to as bottomary bonds, held that the interest and capital repayment was to be paid to the lender upon successful arrival of the goods from sea. With no safe voyage or arrival, the loan was not payable, hence the risk of the venture went to the lender. These instruments were very rare and the premium for them was exorbitant, given the potential downside the lender was taking. The first recorded insurance contract as we would understand it today was in 1347 in Genoa, located in modern-day northern Italy. Now let's briefly turn to insurance fraud. One would be excused for thinking that insurance fraud is a modern-day and complicated endeavour undertaken by many people using complicated technological and other means. However, the history of insurance fraud is almost as old as the history of insurance. One of the earliest recorded cases of this was in the early 1500s, where a boat was sunk deliberately after being overinsured for its cargo. Another case cites ships being sunk with cargo of less volume or inferior quality than the goods insured. It was around this time, the mid-1500s, that insurance contracts became standardized. The market was still relatively small, but there were few other barriers to entry. In other words, one could insure any seagoing cargo, provided they were willing to pay the market premium for doing so. These insurance markets, whilst available to anyone, would typically be limited to people within the merchant trade industry, buyers, sellers, importers and exporters of goods seeking to reduce their risk over time by pooling resources. During this period of enlightenment in Europe, opportunities and populations expanded. This caused more goods to be desired by customers, and the creation of more ships and more seafaring exploration allowed more markets for goods to be sought, as well as other markets from which goods could be bought. This increase in trade naturally increased the demand for insurance contracts. Insuring the seagoing cargo made sense for several reasons. Number one, the capital outlay for the ship and for the cargo was significant and subject to many inherent risks, including inclement weather, disease or ill health of the crew, navigation or other difficulties, cargo spoilage, not to mention the theft or loss due to encounters with pirates. Around 1666, the Great Fire of London further emphasised to a growing population the need and availability to reduce one's financial risk. In 1688, Mr. Edward Lloyds created Lloyds of London, an insurance house. Whilst not an underwriter, Lloyds of London did act as a meeting point for individuals wanting to underwrite or buy insurance products. Lloyds of London still exists today, although in a far more sophisticated but not dissimilar manner. Shortly thereafter, in 1734, the Lloyds List became a regular publication. This is where the success or otherwise end to a ship's voyage was made public and apparent to those interested parties. Hence, the parties may have taken out or underwritten insurance contracts on that voyage. This was less public than a newspaper, but still more public than a private letter, the Facebook group of the 17th century, if you like. In 1744, two Scottish clergy gentlemen by the names of Robert Wallace and Alexander Webster created the first life insurance fund. This was a voluntary participation open to any citizen who would pay sometimes a one-off and sometimes an ongoing stipend into a fund that would be pooled and invested. This was for the purpose of paying out a predetermined amount upon the untimely or premature death of a policyholder to a specified beneficiary. This process was important for several reasons. First of all, this gave far greater access to ongoing financial stability at a low cost to a large proportion of the population. It also paved the way towards what would later become, and what we understand today to be, the modern welfare state. Public health, public education, age pensions are all examples of the welfare state. In conclusion, risk is everywhere. It is inherent in the world that we exist in and the lives we lead. Risk cannot be eliminated, but it can be managed or reduced through the use of insurance contracts. I see it as a nice metaphor for human beings working together. We can all benefit. Insurance not only helps people reduce risk for endeavours already undertaken, it increases the number of economic opportunities entered into. It will be difficult to estimate how many jobs or how much economic output would be lost if insurance contracts were no longer available. Insurance, in its many forms and many types, has been part of our history. It is a part of our present, and it will likely play a central role in our future. This has been Unboxing Economics. Please like and subscribe, and as always, remember, history is more than just a bunch of stuff that happened. Thank you for watching.